Here's a startling but true fact. Most investors, most Australians who get involved in property investment never develop the financial freedom they were looking for. I've read that close to half of those who get into real estate sell up in the first 5 years. And of those still in the game, most never get past their second investment property. However, some investors do very, very well. To help you succeed in your investment endeavours, I today would like to discuss 4 mistakes that most property investors make. I'm wanting to do this so you can avoid them. Before I do, I just want to quickly remind you that I'm doing a series of one-day trainings around Australia in the next couple of weeks. So click on the link below just to find out more about these and join me with finance strategist Rolf Schafer and property tax expert Ken Race as we explain to you a bit about what's in store for the property markets and for the economy, how you can protect your assets, how you can grow your assets in these turbulent, confusing times. Okay, back to 4 common mistakes I see property investors make because I'd like you to avoid them. The first mistake they make is buying the wrong property. Look, to achieve financial freedom through property investment, you need to accumulate a large asset base. This means owning the right type of properties, ones that grow in value strongly and outperform the averages. The sort of thing that you can borrow against them, borrow against the increasing equity so you can fund further purchases. However, when you ask most investors why they purchase their investment property, they'll say things like, oh, it's close to where I live, close to where I want to holiday, close to where I want to retire. These are all emotional reasons for buying property. And look, while they're possibly a good way to buy your home, they're not the right way to buy an investment property. Of course, the alternative is to buy properties based on research and which further your wealth creation plans. Now, I'll be showing you exactly what research to do, what I do, and more importantly, how to interpret it at my upcoming National Property and Economic Update one-day trainings. The second mistake I see investors make is not having a plan. Most Australians spend more time planning their holidays than they do planning their financial future. If you don't have an investment plan, how can you hope to develop financial independence? You see, I find most Australians fall into 4 categories. Firstly, they don't invest at all. Look, a lot of Australians fall into this category, don't they? They just don't take action. The second category is they don't invest enough. Others have bought a home, they understand the power of appreciating real estate, but they want to pay it off first before they invest into more property. This means they're not using the untapped equity in their home to further their financial futures. Another group of Australians, they invest too much. That's right, you can do that. They have taken unnecessary risks and borrowed too much. Investors who are highly geared may run into trouble as interest rates eventually start rising again in the future. And then there's that group who invest just the right amount. Not too little, not too much. They invest just the right amount. Sounds a bit like Goldilocks, doesn't it? For them, every property purchase is part of a well thought out wealth creation plan. The problem is, if you don't have a strategy, it's easy to get distracted by all those so-called opportunities that keep cropping up. Unfortunately, many of these don't work out as expected. Look at all the investors who bought off a plan or in those so-called next hotspots, only to see the value of their properties underperform. The third mistake is not reviewing their property portfolios. Look, property is a long-term investment and the costs of buying and selling real estate are considerable. But that doesn't mean that you should fall into the trap of not reviewing your property portfolio. Of course, you can't easily swap properties or reweight your portfolio like you would with shares, but you should still regularly review your portfolio to see what you can do to improve it or upgrade its performance. When was the last time you checked to make sure you were getting the best rents, or that your mortgage was appropriate for the current times? Maybe it's time to refinance your increased equity. Maybe you want to use the funds as a buffer for the uncertain times ahead, or maybe you want to buy further properties. At my upcoming National Property and Economic Update one-day trainings, award-winning finance strategist Rolf Schafer is going to explain the appropriate finance strategy in today's current market. Do you fix, don't you fix? What do you do? What do you look for? Because the banks are treating some property investors differently. And he's going to teach you what you should do about it. So please join us at these one-day trainings. Just click on the link below this article so you can find out more. Now, sometimes as you review your portfolio, it's appropriate to consider selling an underperforming property to enable you to buy a better investment. Remember, the next phase of the cycle is going to roll on, and as it does, some properties are going to strongly outperform others. And the gap between some properties and others is just going to widen. Underperforming properties are going to go along at a pace and the other properties are going to keep growing. Do you own the right type of property that's going to allow you to take advantage of the next property cycle? If you own secondary properties, or properties in areas that are unlikely to benefit from strong capital growth, maybe it's worth selling them and replacing them with the type of property that will help you develop long-term financial independence. In fact, in the last year, Pam and I sold 3 properties that no longer suit our investment strategy. I'll explain exactly what I sold and what I'm buying at our upcoming National One-Day trainings. Now, the last common mistake I see investors make is not managing their risk. Growing your property portfolio will depend upon you being able to borrow money and hold your properties and keep buying more. Therefore, your ability to service your debt or to borrow additional funds would be a potential risk if it wasn't right. Not being able to service your loans could mean you could be forced to sell a property. Not being able to borrow more would retard your wealth creation opportunities. Of course, the risk management solution to prevent this happening is to prepare budgets and cash flow forecasts, to manage your exposure to interest rate fluctuations, and to maintain cash flow buffers. You see, smart investors don't only buy properties, they buy time. By having these financial buffers to protect themselves, they use lines of credit or offsets accounts, not only to cover their negative gearing, but to see them through the ups and downs of the property cycle. Another way sophisticated investors secure their assets is to buy them in the correct ownership structures that will protect their assets and legally minimise their tax. You see, I've found most wealthy property investors own nothing in their own name, but control everything through companies and trusts. Property tax expert Ken Race is going to be explaining much more about this. It's actually a pretty important topic at our National One-Day trainings, so why don't you join us? Now, as Australia moves into the next stage of the property cycle, I see tremendous opportunities for investors to build a substantial property portfolio. It's going to help many people gain financial independence. Currently, the cycle is giving us a gift. With increased market uncertainty and less demand from buyers, many properties are now on special. Let's make sure we learn the lessons from the past to help us secure our future. I'm going to explain to you exactly what that means, what I'm doing personally when I'm joined by Rolf Schafer and Ken Race as we conduct our national property and economic updates around Australia in the next couple of weeks in 5 states. So if you own a property or thinking of getting involved in property, or you've got any interest at all in property, please click on the link below and join us at these trainings. Of course, I'm going to keep you up to date with how to take advantage of our changing markets in future fortnightly updates here on Property Update. But it's probably appropriate to remind you that in changing times, in volatile times, in funny times like we're now experiencing, no one can quite help you like the independent property investment strategists at Metropole. Remember, the multi-award winning team at Metropole have no properties for sale, so their advice is independent and unbiased. If you want to find out a bit more about what's happening in your local market, if you want to find out a bit about what our research is suggesting is in store, why not join us at a free briefing? This is different to our big one-day seminars, but we have briefings in our offices in Melbourne, Sydney and Brisbane. They last a couple of hours, and with our associates in Perth. You'll also find out about how to achieve that. Go to those at the link below this article. Catch up with you in a couple of weeks. Want to see you at these seminars? I'm Michael Yard.